All right, let's jump right into it. Welcome to today's Explainer, where we're going to unpack what is, honestly, one of the most fascinating financial paradoxes sitting on the stock market right now. We're looking at a company called Oklo, trading under the ticker symbol OKLO. Now, if you follow market anomalies, you already know that sometimes the numbers tell a story that just completely defies traditional financial logic. Well, today, we're doing a strict data-driven deep dive into Oklo. We're stripping away all the noise and looking right under the hood. Because what we've got here, it's basically a masterclass in market psychology, speculative premiums, and just sheer balance sheet survival. Let's decode this enigma.
Section 1. The $11 billion paradox.
So at first glance, Oklo looks like an absolute financial juggernaut. I mean, we are talking about a massive market capitalization of $11.182 billion. Let that just sink in for a second. Over $11 billion. This isn't some tiny small-cap speculative play. Usually, when a company hits this kind of size, it implies a massive operational footprint, right? Immense cash flows, a deeply established market presence. The market has clearly placed an astronomical level of belief and capital into this single entity. But, well, here's the catch.
$0. You heard that right. Despite that $11+ billion valuation, Oklo currently generates exactly zero revenue. Not low revenue, not declining revenue, literally zero. Trailing 12-month revenue, $0. This right here is the hard twist of the Oklo paradox. How on earth does a company command an $11 billion price tag without generating a single cent of top-line sales? Well, to understand that, we have to look at exactly how the market has been treating this stock.
Which brings us to Section 2, Explosive Market Performance.
Look, to get to $11 billion on zero revenue, you don't just, slowly inch your way up. You need a massive explosion of market interest. Look at the progression here. In 2023, the yearly return was a super modest 6.45%, just a totally normal, quiet year. But then, look at what happens next. In 2024, the stock jumped 101%. It literally doubled. And then in 2025, it went on an absolute rocket ship trajectory, posting a massive 238% gain. The market wasn't just casually buying the stock, they were aggressively accumulating it, driving that price up exponentially year over year.
But, as you can imagine, with that kind of meteoric rise comes some absolutely incredible volatility. Just look at these extremes. The 52-week low for Oklo was $22.52, and the 52-week high, an astonishing $193.84. That is a massive spread. Sitting at its last close price of $64.98, the stock is still up roughly 188% from its low, yet it's sitting way, way below its peak. And the wild ride isn't slowing down either. Just in the last 30 days alone, the stock surged another 42-ish%. The market is violently trying to price in the value of this company in real time.
Section 3. The zero revenue reality.
Okay, so we've seen the hype. Now it's time to actually look under the hood and see what the fundamental financials look like. Because, let's be real, running a company without revenue is incredibly expensive. Over the trailing 12 months, net income is sitting at negative $105.66 million, their free cash flow, negative $115.37 million, and their return on invested capital, or ROIC, is negative 50.58%. Now, I want to be perfectly neutral here. This is exactly what you'd expect to see from a company in a heavy development phase that doesn't have a product on the market yet. They are burning over $100 million a year to build out whatever future the market is betting on. There's just no operational profitability right now.
And just to really drive this point home, this zero revenue reality, it's not just some recent blip. Their compound annual growth rate, the CAGR for revenue over the last 3 years, is exactly 0%. And over the last 5 years, also 0%. So we're looking at a steady, consistent state of pre-revenue operations for half a decade.
So that leads us to Section 4, Surviving Without Sales.
Now, anyone looking closely at these numbers is going to ask the obvious question. How does a company burning over $100 million a year with zero incoming sales for 5 straight years keep the lights on? Well, to understand their survival strategy, we need to look at a liquidity metric called the current ratio. It's pretty straightforward. The current ratio just measures a company's ability to pay off its short-term liabilities, things like bills, payroll, immediate debts, using its short-term assets, like cash. A ratio of 1 means you have exactly enough cash to pay your immediate bills. A ratio of 2 means you have double the cash you need. Keep that scale in mind for a second.
Oklo's current ratio is a staggering 49.08. That number is just absurdly high. It means Oklo holds nearly 50 times more short-term assets than short-term liabilities. They are sitting on an absolute mountain of liquidity compared to what they owe in the near term. This is their financial armor. This right here is exactly how a company burns $100 million a year without breaking a single sweat. They are incredibly well capitalized.
But it actually gets even better for their survival prospects. Oklo's debt-to-equity ratio is 0. They carry exactly 0 debt on their balance sheet. No loans draining their cash with massive interest payments. No creditors breathing down their neck. So despite the heavy cash burn and the complete lack of sales, Oklo has this pristine financial runway. They've totally fortified their balance sheet to ensure they have the absolute maximum amount of time possible to execute their vision.
Section 5. The ultimate speculative premium.
We now have the complete picture of the Oklo paradox, and it really comes down to a clash of two extreme metrics. On one hand, you have a debt-to-equity of 0, a completely impeccable, flawless balance sheet. But on the other hand, you have a price-to-earnings, or PE ratio, of negative 91.52. Deeply, deeply negative earnings. Now, your traditional value investors, they look at a negative PE ratio and they run the other way. But growth and speculative investors, they look at that 0 debt and they see a blank canvas just waiting for a masterpiece.
Because there are no sales, you can pretty much throw traditional valuation out the window. Investors are paying a price-to-book ratio of 7.07. They're paying an enterprise value-to-assets ratio of 6.51. They are essentially willing to pay a 6 to 7 times premium on the pure assets and book value of the company today. And that price-to-sales ratio? Well, it's mathematically NA, right? Because you can't divide by 0. Every single dollar of that $11 billion valuation is a bet placed entirely on future potential, not current reality.
So the absolutely crucial question we're left with is this. At $11 billion, is the market pricing in a perfect future? Think about it. Oklo has 0 debt, immense liquidity, and the complete unwavering attention of the stock market. But they also have 0 revenue and over $100 million in annual cash burn. The market has handed them the ultimate speculative premium, an $11 billion head start. The question now is whether the reality of tomorrow can possibly live up to the staggering price tag of today. It's a fascinating financial tightrope, and I highly encourage you to keep a close eye on how these metrics evolve. Thanks so much for joining me on this explainer, and keep learning.